Have you ever wondered what really moves the stock market? Most people think it's all about numbers, earnings reports, GDP growth, interest rates, the kind of stuff you see on financial news channels. But what if I told you that's only half the story? What if the real driving force behind the biggest booms and busts in history isn't data but stories? That's right, stories. The narratives we tell ourselves about the future. For centuries, we've believed that markets are rational, that investors are logical beings making calculated decisions. But the truth is, we are emotional creatures, swayed by hope, fear, and the power of a good story. This is the hidden world of narrative economics, and it explains everything from the dot-com bubble to the crypto craze. Let's go back to the late 1990s. The internet was new, exciting, and full of promise. A powerful narrative emerged. This new technology was going to change the world. And any company with a .com in its name was destined for greatness. These people weren't investing based on profits or business models. Many of these companies had neither. They were investing in the story of a new digital utopia. This narrative spread like wildfire through chat rooms, news articles, and word of mouth. Everyone wanted a piece of the future. The result? The dot-com bubble. Stock prices of tech companies, even those with no revenue, soared to absurd heights. It was a classic speculative frenzy, fueled entirely by a compelling narrative. We all know how that story ended, when the narrative changed. When the story shifted from endless growth to unsustainable hype, the bubble burst, wiping out trillions of dollars in wealth. This wasn't a one-off event. Think about the housing bubble in the mid-2000s. The story then was that housing prices could never go down. Real estate is a safe investment, everyone said. This narrative was so powerful that it convinced millions of people, banks, and even regulators to take on immense risk. Lenders gave out mortgages to people who couldn't afford them. Investors bundled these risky loans into complex financial products, all based on the belief that the story was true. When the story finally broke, and people realized that housing prices could indeed fall, the global financial system was pushed to the brink of collapse. The Great Recession of 2008 wasn't just a failure of financial models, it was a failure of a story that everyone had bought into. So how do these narratives work? It comes down to human psychology. We are wired to think in stories. It's how we make sense of a complex and uncertain world. A good story simplifies things. It gives us a clear hero and villain, and it provides a compelling vision of what's to come. When a story about a new technology, a new market, or a new way of life captures the public imagination, it can spread exponentially. This is what economists call contagion. Just like a virus, a narrative can infect a population, influencing the decisions of millions of people simultaneously. Social media has accelerated this process dramatically. In the past, narratives spread through newspapers and conversations. Today, they spread at the speed of light through Twitter, Reddit, and TikTok. Remember the GameStop saga in early 2021? A group of retail investors on a Reddit forum, Wall Street Bets, created a powerful narrative. The story was simple: a band of everyday people taking on the big, bad hedge funds. It was a David versus Goliath tale for the digital age. This narrative went viral, inspiring thousands of people to buy GameStop stock, not because of the company's fundamentals, which were weak, but to be part of the story, to join the movement. They drove the stock price up by over 1,700% in a matter of weeks, causing massive losses for the hedge funds that had bet against it. GameStop wasn't about economics. It was about community, identity, and rebellion. It was pure narrative. Cryptocurrencies are perhaps the most potent example of narrative economics in our time. What is Bitcoin? Really? It's a string of code. It has no intrinsic value in the traditional sense. It doesn't generate cash flow or pay dividends. Its value comes almost entirely from the story told about it. For some, it's the story of digital gold, a hedge against inflation and government overreach. For others, it's the story of the future of finance, a decentralized system that will liberate us from the control of banks. These powerful, almost mythic narratives have convinced millions to invest, creating a multi-trillion-dollar asset class out of thin air. The price of Bitcoin doesn't rise and fall based on balance sheets. It rises and falls based on the strength and spread of its story. When a figure like Elon Musk tweets about it, the narrative shifts, and the price follows. This isn't to say that economic data is irrelevant. It absolutely matters. But data is often interpreted through the lens of a pre-existing narrative. When the prevailing story is optimistic, investors will focus on positive data and dismiss the negative. Think about the bull market of the last decade. Even when faced with troubling signs like trade wars or geopolitical tensions, the market often shrugged them off. The dominant narrative was that central banks would always step in to support asset prices, the Fed put, as it's called. This story created a sense of invincibility, encouraging investors to keep buying. Conversely, when the narrative is pessimistic, even good news can be ignored. During a market crash, the story is one of fear and uncertainty. Every piece of data is interpreted as a sign of impending doom. This is when panic sets in. The narrative of get out at any cost takes over, and people sell irrationally, driving prices down far below their fundamental value. The stock market crash of 1929, which ushered in the Great Depression, was preceded by a story of a new era of permanent prosperity. When that story shattered, it was replaced by a narrative of despair that paralyzed the economy for years. Understanding this is crucial for any investor. If you only look at the numbers, you're flying with one eye closed. You need to ask yourself, what is the dominant story in the market right now? Is it a story of hope and innovation, or a story of fear and decline? Who is telling the story and why? Is the narrative gaining momentum, or is it starting to fade? Recognizing when a story is reaching a point of irrational exuberance can help you avoid getting caught in a bubble. And understanding when a narrative of extreme pessimism has taken hold can present incredible buying opportunities. The great investor George Soros built his career on this idea, his theory of reflexivity. He argued that investors' beliefs don't just reflect reality, they actively shape it. A belief that a stock will go up leads to buying, which causes the stock to go up, reinforcing the original belief. It's a feedback loop. Narratives create their own reality, at least for a while. So the next time you see the market making a wild move, don't just ask what does the data say. Ask what's the story. Because in the grand theater of the global markets, the most powerful force isn't found in a spreadsheet. It's found in the stories we tell ourselves about tomorrow. The economy is not a machine. It's a conversation. And those who listen to the stories being told are the ones who will truly understand the direction it's headed. Thanks for watching. If you found this exploration of narrative economics insightful, make sure to like this video and subscribe to the channel for more deep dives into the forces that shape our world. See you next time.